Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ted Dixon, CEO and co-founder of InkResearch.ca. He invented the Inc. Canadian Insider Index, which is used by the Horizons Canadian Insider Index ETF, a 2017 and 2018 Fund Data Fund Grade A Plus award winner. His website, CanadianInsider.com. Welcome back to the show, Ted.
Well, it's great to be back, Jim.
Ted, the federal government on both sides of the border shoveling out billions, in some cases like in the U.S., trillions of dollars of stimulus to keep businesses afloat. Will it keep the businesses afloat, or will this just be wasted money?
Well, I think that's an excellent question, Jim, which will be answered over the next few months. Generally speaking, it's, I guess you could describe it as, in one sense, a lifeline. In the other sense, it could also be, you could be giving first aid to zombies. So it's really depends on, I think, the situation, company to company, of course. But look, anytime you have government intervention in the economy, and without sort of getting into the merits of any of these programs, whether it's the right thing or wrong thing to do, let's just deal with sort of, as investors, what this means. We have government intervention, which means that it's going to distort what naturally would have happened under a free market. Okay, whether you applaud that or whether you believe that that's a shame that you didn't let the market forces happen. The fact of the matter is we've got this government intervention here. So what does it mean? It means that you're going to have a lot of bad run companies that trade on the stock market are still going to be trading on the stock market as bad run companies in an environment where you've got the federal where you've got central banks pumping liquidity into the system, artificially inflating asset prices. Okay, so that makes it really hard for investors, and also hard for not just retail investors, but institutional money managers, because they've got to invest money into the market at inflated valuations, into companies potentially that really shouldn't even be there. Okay, so what's going to happen? You can basically make a case, well, this is just more of the QE game that we had under Ben Bernanke, and it's just, so you just do the same playbook. You just load up on big tech winners that you know are not going to go out of business, are unlikely to go out of business. Never say never, but it's unlikely that Amazon's going to go out of business in my lifetime. One never knows. Maybe I'll live a long, ripe age, and there'll be massive technological change, and Amazon will have its day. But over the next 10 years, you could just sort of bet on what worked in the last 10 years, because it's a similar environment. But there is a big difference, and that is not only have governments been bailing out companies, they've been bailing out people. We've had sort of this, one person described it almost as a QE for the people. And in a sense, we have that. I think we have more of that in Canada than in the U.S., but in the U.S. they're doing pretty good too, in terms of, depending on what government program you're eligible for. So you've got more extremes, and we wrote about this to our clients today. Basically, our insiders signaling a big shift ahead, and we've got this standard handouts to business that we saw back in 2008, 2009, but we also see big handouts to people. We're continuing to see that these programs roll out. So not only have you got zombie companies sort of on the stock market, but you've also got consumers now who will have more money than they would have coming out of this downturn because of the government, but you've also got bigger government debts. You've got and the potential for higher inflation. So we've got a much different type of environment, I think, going up the next 10 years than we did in the last 10 years, even though there are a lot of similarities on the surface with these corporate bailouts. There's a lot more going on. There's been a lot more government spending, and a lot of that is in the hands of individuals. And the big question is, what do they do with it, and what impact does that have on the economy as investors? How do we position ourselves for that type of a world going forward?
Are people who finally find themselves with some extra cash going to pay down debt with it instead of going out and buying new things, which the government hopes they'll do?
I think you're going to see some of that. But, a lot of people who are getting the support, may not have a lot of debt because they weren't able to accumulate it because it didn't have the credit availability that some others did. So it's going to be a really mixed outcome, and everyone's situation will be different. So yes, there'll be definitely some of that, but there'll also be this a group that will get this money and they will spend it, and so you're going to have a lot of different forces at work, and so that will be very interesting. That'll be very interesting in the retail space in Canada to see which companies do well. There's a tendency, sort of a knee-jerk reaction to think, well, dollar stores and low-end low-end retailers won't do very well because their customers are hurt the hardest. Subprime lenders will be hurt the hardest. Not necessarily. Not if their customers actually pay off their debts and actually spend their money, compared to maybe some more upstream retailers whose customers do what you've just suggested, that they rein in their horns, they don't spend as much. So as investors, we have to be on the lookout for those sort of retail companies that will benefit from these government handouts, as opposed to those retailers who won't benefit as much because their customer base will just be more conservative, due to having to pay off debts, worried about their mortgage. So we've got a very, very different environment that's emerging. It's actually, as someone who writes about the investing landscape, it's actually quite exciting because I think it's going to change from that the dreadful central bank economy that we had over the past 10 years, where in Canada it all went, for the most part, went into real estate, and in U.S. it went into the stock market, and private equity and all those assets that really help the 5 and 1% who own assets that made them even richer. We're into a different environment here, so it's going to be quite fascinating. We characterize it as either being a de-environment for deflation, which would happen if that outcome that you just suggested takes place, where everyone, including governments, decide to pay off their debt next. Like that, if that's the next stage, then we're heading for this D-economy, deflation, disinflation, everything slows down. Get used to this $5 oil. We've had a nice rebound here today, but that'll be about the extent of it. That would be the D-economy. The alternative is what we call the G-economy, for government-led inflation. G, unfortunately, does not stand for real growth. It stands for government-led inflation, where the government has gone in and made so many transfers to people, bailed out so many different entities and so many different groups in society that there's enough to stimulate demand, to push up demand for goods and services, basic goods and services. But this is happening in an environment where supply chains have been challenged, where we've had not only sort of a surge in protectionism in the purest sense, in that we have to, we can't rely on foreigners to, for our food supply and our medical supplies, we have to make everything here. Then, and there may be sound reasons for that, and, for national security reasons, not necessarily protectionism, but it's going to impact the supply chains. And, so if globalization takes a step back, yet you've got sort of a pickup in demand, you're going to have inflationary forces. So that would be the G economy, the government-led economy. That's our base case out in the future. The question is, how much of this D economy do we have to go through? When you look at days like today in the stock market, where you see, the Canadian Center Index was up 2%, oil, bounced, just about everything was up today, except bonds sort of struggled. That's signaling, if on a one-day basis, that the D economy is over and we're heading for the G economy. I'm skeptical of that. I think that we're going to have to see a few more signs that we've gone through this depression period, and that we're riding a G economy, an inflationary, I'll call it a wave, but certainly we're going down that path. I'm not sure we've turned onto that path yet, but maybe we have. And it will catch us by surprise. And I don't profess to be able to have a magic signal to say, oh yeah, we're there. I would just be skeptical that after 2 months, we're done with all the harsh realities of what has happened. I would be surprised if 2 months is it. But we've had a massive government intervention. We've had massive central bank intervention. Perhaps 2 months is the extent of the depression. But I'd be surprised if that were the case.
We'll have more with Ted Dixon right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Ted Dixon. Ted, what kind of signals are insiders giving you?
So it's very, very interesting what we're seeing. We have yet to see a confirmation that the March 23rd lows were a durable, strong lows. To see that, we need to see peak insider buying. Why is that? Because insiders tend to have their peak purchases right around the lows. That's traditionally what we see. We have not seen that yet. So that means one of two things. It means that we're going to have a retest of that low and probably have lower lows here, at least one more lower low. Or it could just mean that it reflect the uncertainty of the environment we're now living in. We've been used in the past 10 years, in the Uncle Ben years, the Uncle Bernanke years, of low volatility. Everyone and their neighbor was shorting volatility, writing call options, because volatility never went up, unlike Vancouver real estate prices, which never went down, right? That was the Uncle Ben years. Well, insiders are signaling that those years are gone. We're in a high volatility era, at least. Okay, maybe we're due for a bit more of a test of the downside. So let's say it's either or on that case. So that's one thing that they're signaling. The other thing that they're signaling is that we're still waiting for a bottom in the resource sectors, so energy and mining. We may be, we're probably very close. We may have already seen it. But what's very interesting, both in the United States and in Canada, we're seeing a lot of insider activity in those areas, and areas that nobody in the United States has shown much interest in over the past few years. Yes, there was some interest in energy area. It was a big part of the U.S. market. Now it's not very much. No, basic materials. You'd have to really squint to find a mining stock in the U.S. S&P 500 outside of Newmont. It's a completely foreign concept to many investors in the United States that maybe, mining and energy could be significant forces again in terms of the stock market. Okay, so insiders are signaling watch those two sectors, particularly in the U.S., where they've kind of been left for dead, and even in Canada too. I mean, for years and years, the energy sector has just been nothing but a money loser, and I'm sure there's still a lot of frustration being felt there in that sector. But we are in a bottoming process in that group. We're going to be publishing our top 30 this week of potential oil patch survivors. How long will this deep economy last? Has it only been 2 months? Are we on the road now to recovery? I don't know. I'm skeptical. But, we are in the process of bottoming. Okay, so now is the time you want to be looking for those candidates. You probably don't want to go all in at this point, but you certainly, on weakness, you want to look out 5 years from now, not even that, 2 years from now, we're going to need oil and gas again, okay? And natural gas has already perked up. There's been some big winners already in the Canadian market. Two big winners in the Canadian Insider Index have been Tourmaline Oil and Arc Resources. They're both natural gas focused, and they've been experiencing significant rallies here. Well, because they're natural gas focused, and natural gas has been perky because there's indications that maybe there's going to be less natural gas produced out of the U.S. shale industry. So that's good for Canadian natural gas. So there's a lot of things going on in this shakeout that are providing opportunities. And again, you want to buying sort of towards the bottoming process here. Whereas, under the Uncle Ben years, you just bought things that were kept going up, and you didn't think about maybe we're near the top because there was no top, right? Everything kept going up. So, except volatility, which never went up. So, insiders are signaling that environment is changing. We're in for something different, and it's going to be a lot harder, I think, to make money in the market, which is really good for stock pickers, which is really good for good old school stock picking investment managers. It's really good for any process that has a value component to it. So, for example, the Canadian Insider Index, it has a value component that we look at. That's one of the three main factors we look at. We also look at insiders, of course. We also look at price momentum because that's a major dominant factor of investing. All the passive indexes like the S&P TSX Composite and the S&P 500, those are really momentum indexes because they're based off of growing market cap. The more your company goes up, the more weight you get in that index. So if you've got a value component to the process over the next few years, as we enter into that, what we expect will be the G economy, then that skill set will come in very handy. It's kind of maybe a lost skill set. It's kind of like home cooking. Everybody's kind of rediscovered that with the stay-at-home economy. Well, maybe people are going to rediscover value investing. So we will find out.
We'll have more with Ted Dixon right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ted Dixon. Ted, what's going on with people who like to short stocks?
Well, a few months ago, we introduced a new report on Inc. Research, the short report. Every 2 weeks, IROC, which is a regulatory body, one of the regulatory bodies in Canada, they produce a report of all the stocks on the TSX and Venture and any exchange that has short positions. So we take a look at that. We compare that to what insiders are doing in those in those stocks. So what's interesting is that for a long time, energy stocks were big targets of the shorts. Now they're starting to take money off the table. They're starting to cash in. They've made some good money in that area, and there are still some heavily shorted energy stocks out there, but shorts are, for the most part, taking money off the table, taking some profits. So what are the new kind of areas that shorts are sniffing around at? Well, consumer stocks. They're looking at potential problems, I guess, in the consumer area, and they're also sniffing around in some gold mining stocks, which have had nice runs here. Now, this isn't a widespread phenomenon, but again, gold stocks will not be immune if we enter this value investing environment. Not all gold stocks will fare equally. Some will do better than others. And if we are in an inflationary environment, and I have this discussion with some of my gold mining friends, their view is, well, every gold stock is going to do really well in an inflationary environment. And my point is, no, they won't all equally do well, because some will have high costs, and if they are not able to hedge their energy costs today, and some of them do not have the financial ability to do that, if they're not able to get their loans and their capital structure locked in with these low interest rates today, well, if we do enter into an inflationary environment, their operating costs are going to go up. And their mining costs, are going to go up. Their financing costs are going to go up. So you're going to have some gold miners that are struggling. And you know what, Jim? You don't want to be caught in those names. You want to be in the gold mining names that are going to be leveraged cleanly to a higher gold price, that have their cost structures under control, so that their margins stay intact and rise with the gold price, that they're not struggling because, this mine, and we need to do more CapEx, and we've got more production problems, and we've had to stop production. There are horror stories like that all the time. You don't want those operators. You don't want those mines. You want the mines that have management teams that have proven that they can run low-cost mines, that have made progress in the past 2 or 3 years to reduce their mining operations. If we're headed for an inflationary environment, we believe you do not want to bet on high-cost producers. That, there is a very strong feeling, I think, in the gold mining space that, a high gold price will lift all boats. We disagree with that. We think a high gold price in an inflationary environment will lift a lot of gold mining stock boats, but they will not lift them all.
Ted, any outlook for the Canadian dollar, considering crude oil prices are in the tank?
I really have an agnostic view on the dollar, the Canadian dollar, the U.S. dollar. I take it for where it is, and I think the big question for investors is the U.S. dollar, and not just necessarily against the Canadian dollar, but across the board. And the reason being is, if the U.S. dollar is moving higher, whether it's against the Canadian dollar or or the euro, then it's just going to make it really harder for a lot of countries to get back on their feet. It's going to be signaling, I think, financial distress around the world. So, ideally, what we would like to see is a stable Canadian dollar, and not have it tank, because I think if it's tanking, it's sending very bad signals about the global economy. That will not be good for the Canadian market. It would be part of the D-economy. We've talked about the deflationary economy, where the global economy is deflating. Yes, I know it's inflationary in terms of Canadian inflation, but it would be reflecting a more general malaise around the world, a deflationary malaise. So we ideally don't want to see a weak Canadian dollar. So instead of trying to sort of forecast where the Canadian dollar and the U.S. dollar are going to go, I'm just going to take it for what it's signaling. And if it's falling, if the U.S. dollar is strengthening against Canadian dollar and other dollars, other foreign currencies, that's not a very upbeat sign for global equities and base metal miners and energy sector. I mean, it would be more like the old school that we've had, the old days that we had under Bernanke and early days of QEs. They would just be it's not an environment I would look forward to, but we have to be on the watch for it, because it could come back. As much as we believe we're headed towards a G economy, there's a chance we never get there, and one of the signals will be that we're not getting there is if you've got a persistently strong U.S. dollar.
Ted, thank you so much for chatting with us.
Well, thanks for having me back.
My guest has been Ted Dixon, founder and CEO of IncResearch.ca. His website, CanadianInsider.com. If you have any questions for Ted or any of our other guests, you can send them to info@HowStreet.com. Our YouTube channel is Talk Digital Network. You can find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.